Hello, and welcome to today's video, where we'll be discussing the recent developments in China's tax management policies for equity incentives. These changes, announced by the Ministry of Finance and the State Taxation Administration, are set to have a significant impact on both domestic and overseas listed companies operating in China. In early 2024, two key announcements were made that extend and reinforce the individual income tax, or IIT, policies related to equity incentives. Announcement 1, issued on April 17, allows for the deferral of IIT payments for up to 36 months on eligible equity incentives granted by domestic listed companies. On January 31, Announcement 2 emphasized stricter tax reporting and filing requirements, particularly concerning the consolidation of multiple equity incentives within the same tax year. Announcement 1 introduces a significant extension to the IIT payment period, tripling it from 12 months to 36 months. This applies to stock options, restricted stocks, and other equity incentives granted by companies listed on the Shanghai, Shenzhen, or Beijing stock exchanges. To qualify, these plans must be registered with the local tax authority, and the income must be derived between 2024 and 2027. However, this extension does not apply to equity incentives granted by overseas listed companies. For companies, particularly those listed overseas, the absence of this deferral option means immediate attention is required to assess the potential impacts. KPMG recommends that these companies thoroughly understand the regulatory changes, simulate cost implications, and communicate effectively with their employees. It's also crucial to meet all tax information reporting and filing requirements to avoid any compliance issues. Announcement 2 strengthens the tax reporting framework for equity incentives. It mandates that taxpayers consolidate multiple equity incentives from one or more employers within the same tax year. This consolidation ensures accurate tax computation and prevents underpayment of taxes. The introduction of a new module for consolidated tax filing in the IIT system marks a critical step forward, although some challenges remain, such as potential errors in income aggregation. As tax authorities tighten their grip on equity incentive taxation, it's more important than ever for companies to conduct regular tax health checks. Ensure that all tax filings are accurate, especially when employees have received multiple equity incentives. Communication with employees is key to ensure they understand the need for timely and correct tax filing. KPMG will continue to monitor developments and provide updates as new rules and optimizations are introduced. Thanks for watching. For more insights on China's evolving tax landscape, be sure to subscribe and stay tuned for our upcoming videos.